Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Moroz investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at More who find excitement in delivering on Be Boring, Make Money. Today, we have Paul Moroz, our Chief Investment Officer, on to talk a little bit about global balance, a little bit of history behind investing globally, why we invest in a global balance mandate at More, and a little bit of look forward.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Well, maybe I want to take listeners back and provide a little bit of history, because I think the way the world unfolded set up the reason for why we launched Global Balanced in the first place. If you go back far enough and think about some major events, globalization changed pretty significantly. In 1989, you had the fall of the Berlin Wall, which really signified the end of the Cold War. And in that world before, it was closed off. Economies were more closed off. Stock markets were closed off. And what that effectively meant was that for global investors at the time, there is a greater chance that stocks would, in one country, would zig together as that country's prospects were doing good or poor. And another country, which was not as integrated into the global economy, would go the opposite direction. And you would have a better shot at these correlations making sense to buy one country or buy in another country. And I think the way the world was structured, it influenced how investment management companies around the world put together their balance funds. And asset allocation became, to a large degree, based, at least with the equity sleeve, on which country you want exposure to. Do we want to increase exposure to US equities or decrease exposure to Canada? And balance funds were put together in that manner. But post 1989, the world started to open up. You had Netscape, the first internet browser, pop up in 1993, which further opened things up. And I think we've seen the last 25 years a whole wave of globalization, which has resulted in the world, at least stock market wise, starting to move more in the same direction. And so I think the entire premise of finding companies within a particular country and saying now is the time to buy this country, that's not the same as it was before. I think the other thing that's happened is the companies themselves have gone a lot more global. When we talk about investing, whether it's the UK or the US, these are all really global companies, and they themselves are investing globally. They're really conglomerates. They're global citizens at the corporate level. In the current global paradigm we're in, we found that it was made a lot more sense to select individual securities and finding opportunities rather than trying to pull a lever on a country or a region. And that's the backdrop for why we think that our global balance fund made a tremendous amount of sense for this environment, because we're building it stock by stock, brick by brick, and picking up individual opportunities that relate to management teams and business models and the unique idiosyncratic risks and ups and downs of that individual company, and building the portfolio in that manner. And that's a huge difference compared to the other balance funds, even our existing balance fund, which is still moves with levers of should we increase the United States or Canada exposure. It's different.
And I just want to get you to tell us maybe what the reasons behind picking specific geographies in building a balanced portfolio were back then. Is it there's less correlation between countries so that the diversification benefits and getting on a proper, efficient frontier back then was more important? The most important element was your country allocation? as opposed to we've gone through this period of mass globalization where companies are pulling all their own global levers so that from a bottom-up perspective, you don't have to worry about country-specific diversification. You have to worry about other buckets.
That's exactly it. Imagine, 50 years ago, if you were to buy BMW in Germany, and they're mostly selling BMWs in Germany and maybe Europe. Today, there's so much trade that occurs with BMW and China that a very good chunk of their profits are actually from the Chinese economy, really. And so if there's something that's going on in China, that's going to hit BMW and their whole supply chain in Germany. So that's the interconnection that is present in today's economic paradigm that wasn't present before. And that means you're absolutely right. Things are more related. In the past, you had those opportunities where the correlations were different. And that's why you thought about things in terms of different countries.
So the past was country specific. We've moved to less country specific, business model specific. Was that the main driver to launch a global balanced fund?
Well, the other one is diversification. There's this concept of being better diversified by whether it's business model, whether it's country, whether it's currency, whether it's political risk. I mean, as you know, our head office, of course, is in Calgary in the West. How much political change, political risk have we seen in Alberta over the last few years? It's significant. If we can step back and think about the solution that we're trying to provide to our clients, which is really peace of mind, how can we put together investment solutions that are diversified and resilient and don't rest on any one factor that could have repercussions from an investment standpoint? And we've seen that with, say, Canadian securities. If you were invested just in Canada, you would have been hit by a number of Canadian specific factors. And that's one of the reasons I think Global Balance has done a lot better. It provides that diversification and resilience.
Diversification and resilience. The asset mix. Let's just talk a little bit about asset mix and maybe a few comparisons here to our balanced product. So if we look at the world capital markets, Canada is roughly 3% of global stocks. Yet we have a balanced product that has over 20% in Canadian equity, and we have a global balance that's roughly 7%. So let's just talk through diversification and resilience benefits over time there.
Well, I mean, I think there's a couple points here, is that the pure investing is really done to solve a problem. You're trying to think about what expenses, whether it's an individual or an organization, has in the future for whatever it is you're trying to achieve, whatever goal, whether it's your education or whether it's buying a home or whether it's some foundation that requires capital for a cause, right? All you're trying to do is figure out how can we match off those expenses kind of with the asset. It's an asset liability matching problem.
Right. I'm a hospital foundation. All my donation money comes in. It's all Canadian. All my capital is coming in Canadian. Yet, do we invest it all Canadian? Is that the mindset?
Well, that's exactly where I'm going. It really depends on, where's that expense located? Is that expense, is it that you are going to buy Canadian real estate that's going to be paid for in Canadian dollars? Each person or organization has to look at that match. But the truth is, even though you might be buying things or solutions or whatever it is in Canada, a lot of that stuff is imported in anyway. It's a global market, whether that's steel, whether that's a BMW car, whether that's wine for Italy. So I think many people have a home bias. This is true not only for Canada, but everywhere else. That's inappropriate. It overestimates the match that's required for expenses in your local currency. And in reality, it's a psychological issue. There's been a number of scholars that have done work on the cognitive fallacies that people engage in thinking about this home bias, and it's an investment error quite often. So that's one of the things that the Global Balanced Fund corrects for is like, well, let's put the best portfolio together regardless of, where you're sitting in the world. And we're really trying to bring that to our clients.
Okay. So help me understand. Global Balance would be designed first and foremost for a Canadian-based client, or could be anybody?
Well, it certainly has some Canadian exposure, but I think the answer is it would be anywhere. I mean, the thought experiment that we have, and this is for global equity, which makes up the equity portion of the Global Balance sleeve as well, is if you were just completely agnostic, you were floating in a boat in the middle of the Pacific Ocean, and you want to put the best investment portfolio.
I don't know if I'd be
possible.
thinking about investments if it was just floating in the Pacific Ocean.
That's exactly what I'm thinking about, Cam. How do you build that portfolio if you're not tied? What's the best, both theoretical and practical portfolio that you can put together?
So that's the objective. So you mentioned new paradigm.
Well, yeah, there's a couple new paradigms.
We won't list them all off, but the most obvious one is trade wars going on. And if you think back to where we started the podcast, is closed markets. So are we coming full circle, or how do we position a Global Balance portfolio in, for lack of a better term, in a new paradigm?
I think that it's impossible to know the future, how far the countries take this, but there's certainly leaders in power that are seem to be retrenching. They're pulling back. And I don't know how far it goes. There's obviously some legislation that came in the United States during the Great Depression. I think it was the Smoot-Hawley Act, which really clamped down on trade. And it was responsible, some people think, for a much more significant recession and slowdown. I'm not sure we're going to go that far. We're going to look back on the relationship that China has with the United States and say, wait a minute, that's the equivalent Smoot-Hawley Act. It's really tough to say. But we have, from a portfolio perspective, made little changes that recognize there has been a subtle shift. So things like companies that maybe are more dependent on the existing tariff system, we've shifted away from those. Our investment in Intertek, which benefits from trade, they're a testing inspection company. We've reduced our position because we think, well, maybe the cards have come up that maybe there's going to be less work, or the growth prospects aren't as much as this paradigm has shifted. That's one element of new paradigm. I think, frankly, we have a bit of a new paradigm in Canada, in Alberta too. And this has been on my mind a lot, because I think given the political challenges of, very simply, building a pipeline and moving oil out of Canada, which is a pretty big part of the Western Canadian economy, and it doesn't seem like this is getting done anytime soon. And the Alberta economy, I think, is struggling more and more. And even from a stock market perspective, given where real estate prices are, I think we saw the other day, Vancouver prices had declined a little bit. And obviously there's another side to that. You want to make housing affordable, but that has an impact on the banking system. And of course, energy and financials are big parts of the Canadian stock market. So just from both playing defense and from a capitalist point of view, if I look at the next 5 years and weigh the odds of what's going to happen with the Canadian stock market, I think that there's a good chance going global, you just absolutely clean up on a relative basis.
That's a strong statement. Absolutely clean up.
Absolutely clean up.
What makes you think that?
Well, in that scenario, because you still might not have a pipeline moving out. You don't have companies reinvesting in the energy sector. Real estate, you might have seen the best days because of all the quantitative easing, and basically you have prices that are stagnating or declining, and that might weigh on what banks can do in terms of loan growth. If you do hit the end of the business cycle, you very well might have a recession that creates credit problems, and you see real estate prices leg down in Canada. So I'm talking about a very specific scenario. I'm not forecasting, but in that scenario, having your all your eggs in one basket, just in Canada, presents some tremendous risk. And then you get clubbed over the head with the currency declining in certain scenarios. So When I compare that to having a global balanced solution, I think that's pretty attractive. Now, there's another side to it, because maybe you don't end up in that negative Canadian story. Maybe we get the pipeline built, oil prices go up, Canadian dollar strong, housing market holds together. And in that scenario, your Canadian balance funds are going to do very well. And there's going to be a currency impact too. That's one thing that listeners should know. We run unhedged portfolios currency-wise for the diversification. So in that positive, call it the positive Canada event, your Canadian dollar's increasing, yep. And that's making the relative returns of foreign investing a little less.
Right. And then vice versa.
Right.
So let's quickly cover why we don't hedge. Like, why would we not hedge?
Diversification, resilience.
Okay, but hedging is a form of that. So why wouldn't we formally hedge currencies?
Let's think about that. Hedging is a form of putting all your eggs in one basket. So if you were in, I don't know, Iceland during the financial crisis and you hedged all your foreign currency back, and then the banking system blew up and your currency declines, there's a heck of a lot of risk in that strategy. What people see as risk is really just, in the currency markets, is really just volatility. I would take a volatile, well-balanced, currency diversified global portfolio any day over putting all my eggs in one basket in any currency. It doesn't matter whether I'm living in Canada or Singapore. I would never have all my assets in one currency.
Right.
The exception being, I would think about that asset liability matching problem. If I knew I had an expense, a future expense in that, then I'd do the math and I'd make sure.
If you have a known cash flow in a certain currency, then okay,
exactly,
hedge it. You can sleep at night.
Yeah.
And help us understand within global balance the global bond component. Like where does that fit in the resiliency and diversification bucket?
Imagine the scenario where Canada has a housing crisis like what happened in the United States, and you have bank failures. And imagine what happens to the Canadian currency. And so even just the option of having the global balance fund where we can shift away and diversify if there starts to be a problem, that's a huge option. It's absolutely huge. As I tell my wife with things that relates to our kids, low risk doesn't mean no risk. The global bond fund within the global balance fund, I think, has significant strategic value and optionality. And that's one thing that's not well understood, because most people are looking at the current existing paradigm where you get paid and you get currency is fine. But I think it's our job to think around corners and different risks that might occur, even if it's a very low probability.
Why don't we just wrap it up with on a go forward basis, Paul? Like just give us maybe the top 3 reasons we should be, as an investor, you should be thinking global.
Well, I think you have access to better opportunities in general. I would always give a broader mandate to active managers. You have better resilience and diversification. And I think the setup in Canada doesn't look good over the next 3 to 5 years. I'm not saying that's what occurs, but if I'm just playing the odds here, and certainly my money's in global for what it's worth.
Okay. Thanks for joining us and explaining why global balanced.
Thanks, Cam.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.